Hello guys, and welcome back to Trade to Learn. Today, we'll dive into three main ways of investing: value, growth, and momentum investing. We've already made a video on one of the biggest trading strategies, dollar cost averaging, so go check it out if you have not already. On a side note, Trade to Learn is now part of the Financial Literacy Committee, which is backed by the Sammamish Youth Board. FLC is hosting its first event on June 10th with two amazing guest speakers from Fin&Me Wealth Partners. The event is from 6:30 to 8 on Google Meet. The RSVP link and details are in the description below, so make sure to join. Now, back to the video. So, let's start off with value investing. Value investors are like bargain shoppers. They want stocks that they believe are undervalued. They look for stocks with prices they don't believe fully reflect the intrinsic value of the security. Thousands of value mutual funds give investors the chance to own a basket of stocks thought to be undervalued. The Russell 1000 Value Index, for example, is a popular benchmark for value investors, and several mutual funds mimic this index. For those who don't have the time to perform exhaustive research, the price-to-earnings ratio, PE ratio, has become the primary tool for quickly identifying undervalued or cheap stocks. This is a single number that comes from dividing a stock's share price by its earnings per share, EPS. A lower PE ratio signifies you're paying less than $1 of current earnings. Value investors see companies with low PE ratios. The average PE ratio is 20 to 25, so any value less than that would appeal to value investors. But now, who should use value investing? Value investing is best for investors looking to hold their securities long term. If you're investing in a value company, it may take years or longer for their businesses to scale. Value investing focuses on the big picture and often attempts to approach investing with a gradual growth mindset. People often cite legendary investor Warren Buffett as an epitome of value investing. In addition, value investing has historically outperformed growth investing over the long term. One study from Dodge & Cox has determined that value strategies has underperformed growth strategies for a 10-year period in just two periods over the last 90 years. Those periods were the Great Depression and the technology stock bubble. That leads us right into growth investing. Rather than looking for low-cost deals, growth investors want investments that offer strong upside potential when it comes to the future earnings of stocks. It can be said that growth investors are often looking for the next big thing, but however, it's not a reckless embrace of speculative investing. Rather, it involves evaluating a stock's current health as well as potential to grow. A drawback to growth investing is a lack of dividends. If a company is in growth mode, it's often needing capital to sustain its expansion. This doesn't leave any or much cash left for dividend payments. Moreover, with faster earning growth comes higher valuations, which are, for most investors, a higher risk proposition. While there's no definite list of hard metrics to guide a growth strategy, there are a few factors an investor should consider. Research from Merrill, for example, found that growth stocks outperform during periods of falling interest rates. It's important to keep in mind that at the first sign of a downturn in the economy, growth stocks are often the first to get hit. Keep in mind that growth investing is riskier and generally only thrives in certain economic conditions. Investors looking for shorter investing horizons with greater potential than value companies are best suited for growth investing. But because growth companies are generally smaller and younger with less market presence, they're more likely to go bankrupt than value companies. It could be argued that growth investing is better for investors with greater disposable income, as there's a greater downside for the loss of capital compared to other investing strategies. So, growth investing seems quite risky. But let's look at momentum investing to see which one might be the best for you. Momentum investors ride the wave. They believe that winners keep winning and losers keep losing. They look to buy stocks experiencing an uptrend because they believe losers continue to drop. Momentum investors are heavily reliant on technical analysis. They use a strictly data-driven approach to trading and look for patterns in stock prices to guide their purchasing decisions. Momentum investors act in defiance of the efficient market hypothesis, EMH. For those who don't know what that is, in simple terms, here's what it means. According to the EMH, stocks always trade at their fair value on exchanges, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. Therefore, it should be impossible to outperform the overall market through expert stock selection or market timing, and the only way an investor can obtain higher returns is by purchasing riskier investments. In addition to being heavily active with trading, momentum investing often calls for continual technical analysis. Momentum investors rely on data for proper entry and exit points, and these points are continually changing based on market sentiment. After all this information, what could this mean for you? If you're a high-risk, high-reward person and have the time and energy to actively trade, go for momentum investing. If you would rather find information and buy stocks that are under the intrinsic value, go for value investing. And last but not least, if you can take a little risk and want to find companies that could go big, go for growth investing. That was all for this video. Hope you enjoyed learning about these 3 strategies. Make sure to join the FLC event and find your way to the FLC website with weekly articles on financial topics in the description below. See you next time!